Holding Company Business Plan. Holding Company Business Plan. By ChatGPT asked by Shawn San. Write me a business plan on building a holding company named Dragon Results Holding Incorporated owned by a trust as Shawn and Lindsay San are executive directors. The holding company's headquartered is Rochester, MN. Dragon Results business's model is taking care of all of the top-line marketing duties for a percentage of revenue or partnership/equity in the company. Focus on sales, buying solid businesses that lateral to our core of financial services, capital management, investment in Forex and CTA-style trading. All profits go back to holding companies to buy more. Executive Summary. Dragon Results Holding Incorporated, a holding company headquartered in Rochester, Minnesota, is focused on providing top-line marketing services for a percentage of revenue or partnership/equity in the company. The company is owned by a trust with Shawn and Lindsay San as executive directors. The company's core businesses include financial services, capital management, investment in Forex, and CTA-style trading. The company's goal is to use its profits to acquire more businesses that are laterally related to its core offerings. Business model. Dragon Results Holding Incorporated's business model is to take care of all the top-line marketing duties for a percentage of revenue or partnership/equity in the company. The company will focus on sales and buying solid businesses that are laterally related to its core offerings of financial services, capital management, investment in Forex, and CTA-style trading. All profits generated by the company will be used to acquire more businesses. Marketing strategy. The company will use a variety of marketing strategies to promote its services and attract potential clients. These strategies include networking and building relationships with potential clients and partners, advertising through various media channels, such as online and print, participating in industry events and conferences, utilizing social media and other online platforms to reach a wider audience. Operations. Dragon Results Holding Incorporated will be headquartered in Rochester, Minnesota. The company will have a team of professionals with experience in financial services, capital management, investment in Forex, and CTA-style trading. The company will also have a dedicated marketing team to handle the top-line marketing duties for its clients. Financial projections. The company's financial projections will be based on the revenue generated by its clients and the businesses it acquires. The company's goal is to generate enough revenue to cover its expenses and acquire more businesses. The company will also be looking for additional funding from investors to support its growth. Conclusion? Dragon Results Holding Incorporated is a holding company that aims to provide top-line marketing services for a percentage of revenue or partnership/equity in the company. The company's core offerings include financial services, capital management, investment in Forex, and CTA-style trading. The company's goal is to use its profits to acquire more businesses that are laterally related to its core offerings. With a solid business model and a dedicated team, the company is well positioned for success in the industry. Can you explain what kind of licensing does a company like this need to operate in the USA? A holding company like Dragon Results Holding Incorporated may be required to obtain certain licenses and permits in order to operate in the United States, depending on the specific services it offers. Some potential licensing requirements for a holding company that provides financial services, capital management, investment in Forex, and CTA-style trading may include securities licensing, if the company is involved in buying, selling or trading securities. It may be required to register with the Securities and Exchange Commission, SEC, and/or the Financial Industry Regulatory Authority, FINRA, depending on the specific activities of the company. It may also be required to register with the Commodity Futures Trading Commission, CFTC, if it is involved in trading commodity futures or options. Investment advisor registration, if the company provides investment advice to clients, it may be required to register with the SEC as an investment advisor. Money services business registration, if the company provides money transmission services. It may be required to register as a money services business, MSB, with the Financial Crimes Enforcement Network, FinCEN. State licensing, depending on the state in which the company is headquartered, it may be required to obtain specific licenses or permits in order to conduct business. For example, it may need to obtain a license as a financial services provider or investment advisor from the state's Department of Financial Regulation. It is important to note that these requirements may vary depending on the specific services offered by the company and the state in which it operates. It is recommended that the company consult with an attorney or other professional with expertise in these areas to ensure compliance with all relevant laws and regulations. What would be required for the accounting process of clients' financial transactions and accounting policies and procedures? For the accounting process of client financial transactions, a holding company like Dragon Results Holding Incorporated would typically need to establish certain accounting policies and procedures. Some key elements of this process may include maintaining accurate records. The company should maintain accurate and complete records of all financial transactions, including client transactions. This includes documenting all income and expenses, as well as all assets and liabilities. Reconciling accounts. The company should reconcile all accounts on a regular basis, such as bank statements, credit card statements, and investment accounts. This will help ensure that all transactions are properly recorded and that the company's financial statements are accurate. Preparing financial statements. The company should prepare financial statements on a regular basis, such as income statements, balance sheets, and cash flow statements. These statements should be prepared in accordance with generally accepted accounting principles, GAAP, and should be reviewed by a qualified accountant. Implementing internal controls. The company should implement internal controls to ensure the accuracy and integrity of its financial records. This may include segregation of duties, regular reviews and audits, and access controls to the financial records. Complying with legal and regulatory requirements. The company should comply with all legal and regulatory requirements related to accounting and financial reporting. This may include filing tax returns, submitting reports to regulatory agencies, and providing financial information to clients. It is important for the company to have a strong accounting process in place to ensure that client financial transactions are properly recorded, that the company's financial statements are accurate, and that it is in compliance with all relevant laws and regulations. It is recommended that the company consult with a qualified accountant to establish and implement appropriate accounting policies and procedures. What is a CTA? A CTA, or commodity trading advisor, is an individual or firm that provides advice to clients on buying or selling commodity futures and options. CTAs are registered with the Commodity Futures Trading Commission, CFTC, and are subject to strict regulatory oversight. CTAs typically charge a fee for their services, which can be based on a percentage of assets under management or a flat rate. CTAs may provide a wide range of services, including market research and analysis, trading strategies, and risk management. They may also use a variety of trading techniques, such as trend following, mean reversion, and quantitative analysis. Some CTAs may specialize in certain markets, such as agricultural commodities or energy, while others may focus on multiple markets. It's important to note that CTAs are different from commodity pool operators, CPOs, and commodity trading advisors, CTAs, which are similar in name but different in nature. CPOs are typically responsible for managing a pool of funds and providing advice to the pool's participants, while CTAs are responsible for providing advice to individual clients. What license does a CTA need to have? A commodity trading advisor, CTA, is required to register with the Commodity Futures Trading Commission, CFTC, and be a member of the National Futures Association, NFA. The registration process requires the CTA to file Form 7R, which includes information about the CTA's background, qualifications, and business operations. The CTA must also pass the Series 3 exam, which is a national commodity futures examination, to demonstrate that they have a sufficient understanding of the commodity markets and the rules and regulations that govern them. Once the CTA is registered, it must comply with the regulations set forth by the CFTC and the NFA, which include disclosure requirements. CTAs must provide clients with a disclosure document, such as a brochure or a Form CTAD, that includes information about the CTA's business, trading strategies, and performance. Risk disclosure. CTAs must inform clients of the risks associated with trading commodity futures and options. Supervision and compliance. CTAs must have procedures in place to supervise their employees and ensure compliance with all relevant laws and regulations. Record keeping. CTAs must keep records of all their transactions and client communications for a certain period of time. Financial reporting. CTAs must submit financial reports to the NFA on a regular basis, which includes disclosing their assets under management and any other relevant financial information. CTAs also must maintain a minimum net capital and meet certain other financial requirements, in order to ensure that they have the financial resources to meet their obligations to their clients. It's important for a CTA to stay current with the laws and regulations that apply to them, as they can change over time, and non-compliance can result in penalties and fines. How long does it take to get the license? The time it takes to obtain a commodity trading advisor, CTA, license can vary depending on a number of factors such as the completeness and accuracy of the application and the workload of the regulatory agency. Typically, the process of registering as a CTA with the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, may take several months. The initial step of the process is filing Form 7R, which is a registration form for CTAs. Once the form is submitted, the NFA will review the application to ensure that the CTA has met all the requirements such as passing the Series 3 exam, and that the information provided is complete and accurate. After the application is approved, the CTA must comply with all the regulatory requirements such as providing disclosure documents, informing clients of the risks associated with trading commodity futures and options, implementing internal controls and record keeping, submitting financial reports, and meeting financial requirements. It's important to note that the time frame for the approval process can also vary depending on the workload of the regulatory agency. The NFA receives a large number of applications every year and the review process can take longer during peak periods. It's also important to keep in mind that if there is any missing information or if the application is incomplete, it can cause delays. It's recommended that the CTA works closely with a qualified attorney or accountant who has experience in the registration process, to ensure that the application is complete and accurate and to help navigate the regulatory requirements. What is a Series 3? The Series 3 exam, also known as the National Commodity Futures Examination, is a test that individuals must pass in order to become a registered commodity trading advisor, CTA, with the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. The test covers a wide range of topics related to commodity futures and options trading, including market terminology and concepts, trading strategies and risk management, federal commodity laws and regulations, ethical considerations and customer protection. The Series 3 exam is a multiple-choice test that consists of 110 questions and must be completed within 3 hours and 45 minutes. In order to pass the exam, an individual must correctly answer at least 70% of the questions. The passing score for the exam is not published by the NFA. The Series 3 exam is administered by the Financial Industry Regulatory Authority, FINRA, on behalf of the NFA. It is offered several times per month at various locations across the United States. Candidates must register in advance to take the test and pay a fee. It's important to note that passing the Series 3 exam is just one of the requirements to become a registered CTA, and passing the exam does not guarantee registration. The individual must also meet other regulatory requirements such as passing background check, meeting financial requirements and other regulatory requirements. What are the financial requirements? The financial requirements for a commodity trading advisor, CTA, are set by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA, to ensure that CTAs have the financial resources to meet their obligations to their clients. Some of the key financial requirements for CTAs include net capital requirement. CTAs must maintain a minimum net capital, which is the difference between their assets and liabilities. The net capital requirement is determined by the NFA and is based on the CTA's trading volume and the amount of customer funds under management. Segregation of funds. CTAs must keep client funds separate from their own funds. This is to ensure that client funds are available to meet any obligations that may arise and to protect clients in case of the CTA's financial difficulties. Risk management. CTAs must have a risk management program in place, which includes procedures for monitoring and controlling the risks associated with trading commodity futures and options. Insurance. CTAs are required to have errors and omissions insurance, which protects them against losses that may arise from mistakes or errors made in the course of their business. Financial reporting. CTAs must submit financial reports to the NFA on a regular basis, which includes disclosing their assets under management and any other relevant financial information. It's important to note that these requirements are subject to change, and it's the CTA's responsibility to stay current with the regulations and to comply with them. In addition, the NFA and CFTC have the authority to require additional financial information and to conduct audits to ensure compliance with the requirements. What's the difference between a hedge fund and a CTA? A hedge fund and a commodity trading advisor, CTA, are both investment vehicles, but they have some key differences. Investment strategies. Hedge funds typically use a wide range of investment strategies, including long-short equity, global macro, and event-driven strategies, to generate returns for investors. CTAs, on the other hand, specialize in providing advice on buying and selling commodity futures and options. Regulation. Hedge funds are typically subject to less regulatory oversight than CTAs. Hedge funds are not required to register with the Securities and Exchange Commission, SEC, but they are subject to certain regulations such as the Investment Advisors Act of 1940. CTAs, on the other hand, are registered with the Commodity Futures Trading Commission, CFTC, and must comply with strict regulations set forth by the CFTC and the National Futures Association, NFA. Audience. Hedge funds are typically geared towards high-net-worth individuals and institutional investors, while CTAs are more accessible to individual investors who are interested in trading commodity futures and options. Minimum investment. Hedge funds often have a high minimum investment requirement, which can be in the millions of dollars, while CTAs may have a lower minimum investment requirement. Fees. Hedge funds typically charge a management fee, which is a percentage of assets under management, and a performance fee, which is a percentage of any profits generated by the fund. CTAs typically charge a fee for their services, which can be based on a percentage of assets under management or a flat rate. It's worth noting that some hedge funds do use commodity trading strategies and may register as a CTA with the CFTC and NFA, in addition to being subject to regulations as a hedge fund. Do you know what the DeLorean Trend Trading System is? I'm sorry, but I couldn't find specific information on a trading system called DeLorean Trend Trading System. The name DeLorean is more commonly associated with a car brand, the DeLorean DMC-12. That was produced by the DeLorean Motor Company, DMC, from 1981 to 1983, and it's famous from the movie Back to the Future. It's possible that it's a proprietary trading system, or a strategy that has been developed by a specific trading firm, or individual trader and hasn't been widely disseminated or publicly discussed. If you have more information about the DeLorean Trend Trading System, please provide it so I can assist you better. Do you want a trend trading system that used 5 and 13 EMA cross as entry and exit would look like? A trend trading system that uses 5 and 13 exponential moving average, EMA, cross as entry and exit signals would likely involve the following steps. 1. Identify the trend. The first step would be to identify the current trend in the market by plotting the 5 EMA and 13 EMA on the chart. If the 5 EMA is above the 13 EMA, it indicates an uptrend, while if the 5 EMA is below the 13 EMA, it indicates a downtrend. 2. Entry signal. The system would generate a buy signal when the 5 EMA crosses above the 13 EMA, indicating that the trend is bullish. Conversely, a sell signal would be generated when the 5 EMA crosses below the 13 EMA, indicating that the trend is bearish. 3. Exit signal. The system would generate a signal to exit a long position when the 5 EMA crosses back below the 13 EMA, indicating that the trend has turned bearish. Conversely, a signal to exit a short position would be generated when the 5 EMA crosses back above the 13 EMA, indicating that the trend has turned bullish. It's worth noting that this is a simple example of a trend trading system, and other indicators or techniques can be added to the system to filter out false signals or to provide additional information about the market conditions. Also, different traders may use different parameters for the system, like different moving averages, different time frame, different entry and exit rules, etc. Additionally, traders should always use proper risk management techniques, such as stop-loss orders, to limit potential losses. What type of markets or direction are there? And how do you tell? In financial markets, there are generally 3 types of market conditions or market direction: uptrend, downtrend, and sideways, or range-bound. 1. Uptrend. An uptrend is characterized by a series of higher highs and higher lows, indicating that the market is in a bullish phase and that prices are likely to continue to rise. To identify an uptrend, you can use trend lines or indicators such as moving averages. 2. Downtrend. A downtrend is characterized by a series of lower highs and lower lows, indicating that the market is in a bearish phase and that prices are likely to continue to fall. To identify a downtrend, you can use trend lines or indicators such as moving averages. 3. Sideways. A sideways or range-bound market is characterized by a lack of clear direction and by prices that are consolidating within a narrow range. This can be seen as a period of indecision among traders, and it's usually seen as a period of consolidation before the next move. To identify a sideways market, you can look for a lack of clear direction, or by using indicators such as Bollinger Bands or the average true range. It's important to note that market conditions can change over time, and it's important for traders to monitor their positions and adjust their strategies accordingly. Also, different markets or assets may have different characteristics. So it's essential to know the specific market or asset that is being traded to have a better understanding of the market direction. What is RSI? Relative Strength Index, RSI, is a technical indicator that is commonly used in technical analysis to measure the strength of a stock or other financial instrument relative to its own past performance. The RSI is a momentum oscillator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. The RSI is calculated by taking the average gain of up closes over a certain period and dividing it by the average loss of down closes over the same period. This calculation results in a value between 0 and 100. The RSI is considered overbought when it is above 70 and oversold when it is below 30. Traders use RSI to identify market conditions and to make trading decisions. When the RSI is above 70, it is considered overbought and may indicate that the market is due for a price correction. Conversely, when the RSI is below 30, it is considered oversold and may indicate that the market is due for a price rally. It's important to note that RSI is a lagging indicator, which means it follows the price, it doesn't predict it. Additionally, RSI is not a standalone indicator and it's often used in conjunction with other indicators, such as moving averages or trend lines, to provide a more comprehensive view of the market. Do you know what TDI is? TDI, Traders Dynamic Index, is a technical indicator that was developed by Dean Malone, a professional trader and market analyst. It's a combination of several indicators, including RSI, moving averages and Bollinger Bands. The TDI is designed to provide traders with a more comprehensive view of market conditions by combining various indicators into one single indicator. It provides a visual representation of market conditions in the form of a histogram, with a range of -100 to +100. The TDI also includes a green, yellow and red zone, which helps traders to identify the strength of the trend and the potential for a reversal. The TDI indicator is used to help traders identify the direction of the trend, measure the strength of the trend, and to identify overbought and oversold conditions. Traders use the TDI indicator to make trading decisions such as entering or exiting trades, setting stop-loss orders, and to determine the overall market conditions. It's important to note that, as with any technical indicator, the TDI should not be used in isolation and should be combined with other indicators. Chart patterns and fundamentals analysis to make a complete trading decision. How can you trade currency for consistent profit? Trading currency for consistent profit requires a combination of several factors, including a solid trading plan, proper risk management, and a deep understanding of the currency markets. Here are a few steps that can help you trade currency for consistent profit. 1. Develop a trading plan. This should include your entry and exit strategies, risk management plan, and your overall approach to the market. Your plan should be based on your goals, risk tolerance, and the time you have available to trade. 2. Understand the market. Currency trading involves a lot of volatility, and it's important to have a deep understanding of the economic and political factors that affect currency prices. Knowing the fundamentals and how they interact with technical analysis will give you a comprehensive understanding of the currency markets. 3. Use technical analysis. Technical analysis is the study of charts and historical price data to identify patterns and trends that can help you predict future price movements. Using a combination of technical indicators and chart patterns, such as moving averages, RSI, TDI or Fibonacci retracements, can give you a better understanding of the market and help you make more informed trading decisions. 4. Use proper risk management. One of the most important aspects of trading currency is managing risk. This includes setting stop-loss orders, using proper position sizing, and diversifying your portfolio. 5. Patience and discipline. Consistent profit in the currency market requires patience and discipline. It's important not to overtrade, avoid impulsive decisions, and stick to your trading plan. It's also important to note that currency trading is not without risk, and traders should always be aware of the potential for loss. It's essential to have realistic expectations and to understand that there will be losing trades as well as winning trades, and that consistent profit requires time and experience. What does a solid capital preservation system strategy? A solid capital preservation system strategy refers to a set of tactics and techniques that are designed to protect an investor's capital from significant losses. Here are a few key elements that a capital preservation system strategy may include. 1. Risk management. This includes setting stop-loss orders, using proper position sizing, and diversifying your portfolio. This helps to limit potential losses and prevent a small loss from turning into a much larger one. 2. Hedging. This refers to taking offsetting positions in order to reduce the risk of loss. For example, a currency trader might use options or forward contracts to hedge against currency fluctuations. 3. Position sizing. This refers to the process of determining the appropriate size of a trade based on the level of risk involved. Position sizing helps to ensure that a single loss does not significantly impact the overall portfolio. 4. Asset allocation. This refers to the process of spreading investments across different asset classes and sectors in order to diversify risk. Asset allocation helps to ensure that a loss in one area of the portfolio is offset by gains in another area. 5. Patience. Capital preservation is a long-term process. It's important to avoid impulsive decisions and to stick to a well-thought-out plan. It's important to keep in mind that capital preservation strategy is not a guarantee of profit. There will be losing trades as well as winning trades. However, a well-designed and implemented capital preservation strategy will help to minimize the impact of losses and preserve the overall value of the portfolio.